Oh, in this video, we'll be going through changes in estimates and prospective accounting. When a corporation has an accounting change or error corrections, there are three different approaches that are taken as to how to account for those and what needs to be shown on the financial statements and disclosure notes. And those approaches, those three approaches, will be determined based on what type of accounting change has occurred. The first type of accounting change is the retrospective approach. And in this situation, financial statements issued in previous years are revised and they have to be made to appear as if the newly adopted accounting method has been applied all along or the error has never occurred. So actually, I should just say that the retrospective approach is used when you have a change in accounting principle, when you have a change from one gap to another principle, or a change in inventory maybe, or change in the equity method to the cost method for change in investment accounting, and if you have a correction of an error. If you're correcting an error, then or change in accounting principle, companies have to use the retrospective approach and restate their prior year's financial statements as if they were revised from the beginning. And also any cumulative effect for those changes are made as an adjustment to the beginning balance of the retained earnings for the first year shown in the financial statements. The other approach is a modified retrospective approach, and that is when a new standard is applied, a brand new standard is applied, you don't have to restate the prior years. You only begin applying it to the year of adoption, but in that year of adoption, your retained earnings has to be adjusted to reflect almost as if that rule had been in place all along, but you just changed the beginning retained earnings for that adoption year, versus when you have a change. So that could be a new principle versus a change in accounting principle, a voluntary change. Like if a company changes their inventory methods, then they would have to use the retrospective approach. The third approach is called the prospective approach, and this is when a change is reflected in the financial statement of only the current year and the future years, and nothing needs to be restated. Additionally, there are no changes to the retained earnings that are made for the prior years or the beginning balance of the current year where there's the prospective approach is being taken. And those are principally used when there's a change in estimate. That's when we use the prospective approach. Let's talk about examples of change in estimate, or estimates in general. A company estimates their uncollectible receivables, right? They might say X% of our receivables uncollectible, and they record allowance for doubtful accounts and their bad debt expense. If they change, let's just say they said 2% of our accounts receivable will be deemed unreceivable. If they go ahead and they change it to 3%, that's a change in estimate, and we just use the prospective approach in that situation. So we just change the current year amount, and going forward, we don't do anything to restate the prior years. Like we don't go and restate the allowance for doubtful accounts to 3% for the prior years shown. Same thing with inventory obsolescence. Companies can estimate how much of their inventory will be, unsold, spoiled, stolen, whatever it is. And so that's a change in estimate. Companies can change their assumption into the useful life or the salvage value of its assets. They can change their liability for warrant costs and income taxes, because they have to accrue the income taxes, but then they won't know the final income taxes until the return is actually filed. So those are all examples of changes in estimate, and we use the prospective approach to account for those. Now this one is a little tricky. Number 5 is depreciation methods. So if I change from the straight line method to, let's just say, the double declining balance method, okay, although that is technically a change in accounting principle, but the rules say that it's really a change in estimate that is achieved by a change in accounting principle, and therefore we call it a change in estimate and use the prospective approach. Whereas most accounting principle is the retrospective. But just know, change in depreciation method will be considered a change in estimate and using the prospective approach. So what does it mean, the prospective approach, when we have changes in accounting estimates? It means that we only change the accounts in the period of change if it affects just that period, or if it affects multiple periods, you account for the period of change and any future periods going forward. And the FASB just views that the changes in estimates are part of a normal recurring corrections and adjustments, and actually prohibits the retrospective treatment. Imagine if we change if we consider every time there's a change in estimate, if that was have to be dealt with on a retrospective basis, that would be a nightmare for all companies. So FASB actually prohibits that from happening. Now, sometimes it's difficult to differentiate, is something a change in estimate or is something a change in principle? Because a change in estimate will require the prospective approach, which is a lot simpler, versus a change in principle requires the retrospective approach, right? So when that happens, it's really hard to say, is this really a change in principle or is this a change in estimate? When that happens, you consider a change in estimate, okay? And you refer to it as a change in estimate affected by a change in accounting principle, but we use the prospective approach. So that's good news. Now, sometimes we also use the prospective approach when the retrospective approach or application is not possible. So that can happen because there's just lack of information makes it not practical to report a change retrospectively. So the new method is just applied to prospectively, and they're done so as of the beginning of the year of change. And you also need to have a disclosure note to indicate the reasons why a retrospective application was not practical. Sorry. So, if this is what I just said, if it's impractical to determine, then you have to apply the prospective approach in the earliest year that it is practical to calculate that change. Let's look at an example when we cannot figure out when we're supposed to use the retrospective application, but we just can't figure it out. So this is when a company can't even calculate what the adjustment would be at the very beginning of the earliest period shown on the financial statement. So you can think of a company switching a complex financial instrument measurement method where historical data just doesn't apply. So instead, they just start the new way of their new policy and their new way of accounting and just apply from January 1 of the current year. And none of the prior period financials get restated, so it's just going forward. Now, sometimes it is impractical, says impractical to determine some period specific effects. What this means is that a company is able to determine the prior period effects. Again, just real quick, I'm sorry. This is when a retrospective application is necessary, is required, but we can't really implement it, whether because we don't have the information, or in this situation, we have the information, we have the cumulative adjustment, but we just cannot break it out into the different years specifically. So in that situation, you apply it retrospectively to the beginning in the earliest year practical, or the earliest year that you have that information for. So let's go through an example. Imagine a company switches inventory methods in 2024 and needs to restate the prior 2 years, 22 and 23. they're able to calculate what inventory would be at the start of 2023, which is the opening balance, but they just cannot break it out what the balance would be in 2022 versus 2023, just because there's just no records. So what do they do instead? They're going to restate from the earliest year where they can figure it out. So in this situation, it would be 2023 is doable, but 2022 is not. So therefore, the 2023 figures get restated, but 2022 is left as originally reported. So basically, it's you do what you can. So let's look at the distinctions between those two scenarios. The first one is when you don't know, this is again, when a retrospective application is actually required, but is not practicable. You cannot really apply it fully. So the first example is if you don't know the total adjustment at all, then you basically are using the prospective approach and there's no restatement. The second example was you don't know how to split the adjustment across the years. You know the total adjustment, but not how to split it. So you just start restating your financials in the earliest year where you have that information. So it's like a partial restatement. Also, this is also kind of like a modified retrospective approach. Sometimes there's a new accounting standards that specifically requires prospective accounting, then that's what's followed. So because usually when we have a new accounting standards, typically it's retrospective, sometimes modified retrospective, but if it specifically states that it should be prospective, then that's how it should be accounted for. When we have changes in accounting estimates, in general, the general rule is that companies do not need to disclose the changes in accounting estimates because they're part of their normal operations, unless the changes are material. So if it would influence the financial reader's decisions in making any sort of investment decisions or credit decisions, then that does need to be disclosed. Now there's exceptions, just like all things in accounting, there are exceptions. If a change in estimate affects several periods, so let's just say we go from changing the service life of a depreciable assets from 5 years to 7 years, right? So we have an extra 2 years because we just think that this asset is going to last us longer, provide more service for us over a longer period of time. In that situation, a company should disclose the effect on the income from continuing operations and any related earnings per share account amounts that have changed for the current period. Okay, just like sometimes it's hard to differentiate between a change in estimate versus a change in accounting principle, we have the same kind of dilemma when we have a change in estimate versus a change versus a correction of an error. So again, a change in estimate gives you the prospective approach, so you only deal with it in the current year and going forward, versus a correction of a error is the retrospective approach, so you have to restate the prior year financial statements. Okay, so sometimes it's not so easy to determine, is it a change in estimate or really correcting an error? So here's the general rule. The general rule is that companies should consider careful estimates that later prove to be incorrect as changes in estimate. So if your estimate was just incorrect, it's still a change in estimate. It's only a correction of an error if the company computed the estimate incorrectly because of lack of experience or it was done in bad faith. So it's really just a correction of an error if a company did it on purpose or they just didn't have the right person because they lacked the sort of expertise to make that judgment call in the first place. Let's do a concept check. And a change in accounting principle, they usually should not be reported by revising the financial statements of a prior period is a change from what? So revising the financial statement tells me it's a retrospective approach, right? Because I'm revising everything. And usually a change in accounting principle requires you to have the retrospective approach. We haven't learned this, so I'm just going to tell you what the answer is. However, if a company changes from one inventory method specifically to the LIFO method, then it's handled prospectively. So any sort of inventory method, whether you have FIFO to LIFO, a weighted average method to LIFO, lower cost of market to LIFO, anything that's changed to LIFO is handled prospectively. And the reason for that is because it's really hard to determine the cost of goods sold when it comes to LIFO for the past.